A lot of times people are so worried about what's going on in the market and the economy and shopping for interest rates and shopping for lenders on what's the cheapest, they don't realize that they're actually cutting their own throat. What's happened to the value of the US dollar over time?
It goes down.
Significantly. I remember walking to my very first Taco Bell 30 years ago. You could get 2 crunchy tacos, 2 bean burritos, and a drink for $1.99. Do you know what that is right now?
I don't.
It'll cost you with tax just shy of 14 bucks. So when people pay their mortgage off early, the banks make more money because the dollar's worth more.
Hey there, and welcome to another episode of the Jack Bosch Show, where we talk about all things finance, real estate, entrepreneurship, and really whatever is interesting in the moment. And I have a really good friend of mine here. He refers to himself as the loan guy, but he's so much more. He does loans, but he's really is like an expert on rates, on interest rates, on economy, you name it. We're going to dive deep into all of this right now. So hold on to your seat because you're in it for a beautiful ride. Welcome.
Now you put the pressure on. I got to give you a beautiful ride. I like
Aaron
the bumpy
Chapman
stuff.
Is here. Aaron Chapman is his name. Haven't even mentioned his name.
Just the loan guy, though.
I just assume everyone knows you, right?
They should. They should. If not, they might now that they've watched your show.
There we go. I like your cap. Good German company.
You. Yes. Hey, you can't beat German engineering when it comes to something that's got a piston in it.
There we go. That's right. Yeah. Good. So tell me about you a little bit. Just tell the audience what you specialize in, what you do, and then let's dive right into the details.
So I would say of all things, my specialty is I'm a people collector. I think relationships and experience is the only thing we're going to leave this life with. So I spend my time collecting people. And you and I collected each other at Collective Genius years ago,
right?
And be able to build that relationship, run into each other all over the place. But beyond that, professionally, how I generate revenue is to help real estate investors secure financing. A lot of times people are so worried about what's going on in the market and the economy and shopping for interest rates and shopping for lenders on what's the cheapest, they don't realize that they're actually cutting their own throat by hunting for something that seems to be, decided on price. Because if you do it incorrectly, all based upon price, you can put yourself in a really bad position as a real estate investor. So let's do some math. You okay with do a little bit of math? Okay, so we're going to talk about the simplest way to become a real estate investor. I know that there's a lot of different ways to go about doing that. You can buy apartment buildings, whatever. But let's talk about the average person that wants to start by buying a rental house. So we'll say it's a $200,000 house. You're going to put 20% down. You're going to have a 30-year fixed mortgage. You're going to get $1,800 a month in rent with $100 a month in cash flow. And it's going to appreciate only 2.5% per year. Does that sound like a good deal to you?
Depends. I mean, it's $40,000 invested and $100 a month in cash flow. Doesn't sound, from a cash flow point of view, it doesn't sound sexy.
Does not sound sexy whatsoever. No. And if you get into the cost structure of it, it could be as much as $10,000 in costs when you're done investing everything in it to close on that transaction. Now you're 50 grand deep.
Right.
50 grand deep with $100 a month cash flow. Most investors would turn and walk away from that deal.
That's a 2% return.
Yeah, it's nothing sexy whatsoever. But let's get deeper into the transaction a little bit more. If you did your job as the CEO of your real estate investment business, and you found a property you can keep reasonably rented the entire time you owned it, and you can raise rents and it appreciates, who pays off the $160,000 loan?
The tenant.
The tenant. So let's take that $160,000, divide it by 30, because you're just going to pay it off over the 30 years that you own the house. I don't subscribe to the David Ramsey method of things of debt snowballing when it comes to investment properties financing. You pay it slowly. So let's say you're following that same thought process. Well, if you pay $160,000 over 30 years, that's equivalent to an average of $5,333.34 per year. Do you agree?
Absolutely.
That's what percentage of your $50,000?
11, 10 and a half, so 10.6.
10.6.
Yes, 10.6.
So, I mean, yeah, pretty close on the number. Most people don't come up with that quickly.
I'm pretty good at mental math, so yeah.
Well, and I hope that this whole process, we'll see exactly how your mental math works out. I've had some people get offended by my math, like, I have a degree in mathematics from Dartmouth. I'm like, I'm trying to text you, dude. We're just syncing up our brains.
Yeah.
So you've got 10.6% just by amortizing the mortgage. Right. So now you're talking about, we live in an inflationary environment. Properties values go up. We've seen them go up as much as 20, 30% at a certain point. But right now, we're going to see about 5% average across the United States when you look at Case-Shiller, Black Knight, CoreLogic. So let's say it's only 2.5% on this house. We set that as a baseline.
And that's over time. Right now, in some markets, prices go down, but eventually they'll settle again. They'll come back. So over 10 years, they might not do anything, but then they hit a boost of 20, 30%. So on average, over 30 years, 2.5% is, I think, pretty good number. Yes.
Extremely, actually, probably a really light number when you consider what could happen. So 2.5% on an average of 200,000 is how much?
On 200,000, 2.5%, that's another 5,000.
$5,000, which is equivalent to 10%.
Yes.
On your 50,000. So averaged over 30 years, you're literally annually making just there 20.6% on the amortization of the loan and the appreciation of the asset. Correct?
Plus the cash. Yeah.
Is it a little bit sexier of a deal now?
Yeah, it is.
You invested $50,000, man. Now you're making 20.6% on an annual basis, averaged over 30 years. Pretty sexy, but that's not where the sexy part starts to come in. We get to raise rents. So we have a baseline set at $1,800 a month rent, not unreasonable for a $200,000 asset, but we're raising rents because of appreciation. Now we've seen rents go really high, we've seen them go really low. Let's say it's an average of 3%. Does 3% increase in rent seem unreasonable average over 30 years?
Sounds okay.
Yeah. It seems very conservative. So what's 3% of 1,800?
That now it's what, 180, 360?
This is where we're testing you.
Yeah, you are. From 1,800, 108, 1836, like $52.
Close, 54.
54.
Still,
okay.
Damn.
Yeah.
Yeah. So 52 is pretty damn good. There's a lot of people are coming up with like 80. They're guessing, right? At that. So $54. Not sexy. Did you get excited about increase of cash flow by $54?
I do, because I understand real estate, but yes, not usually, but...
your novice investor would not be, right? What they don't fail to understand is that your tenant is not going to get excited over $54. They're not going to move out. They're not going to get pissed. They're not going to dump concrete down your toilet because you raised the rent by $54. It's kind of reasonable. But that $54 compounds, right? So when you get to the third year, the fourth year, the fifth year, now you're starting seeing some really good cash flow after 5 years. But here's where the real sexiness come in. Does the lender get to raise the payment on the loan because of inflation?
No, they don't. It's a
fixed for 30 years, right? So we're setting that same dollar amount for the entire 30-year period. Now, when you get into a $160,000 loan at today's interest rates that we're seeing right now, you could see approximately $402,000 in principal and interest being paid over the 30 years. What alarm goes off into your mind when you borrow $160,000, but after 30 years you're paying $402,000?
That is this way more than you paid for the house, or
more than you paid for the house, more than double than what you paid, what you borrowed, right? You borrowed $160, but I'm paying $402. That's when your inner David Ramsey is standing on your shoulder, just punching you in the earlobe, say you got to pay it down, do the debt snowball, pay extra on your payment, get that paid off quickly. Well, this is what I'm telling you: don't do that. Don't think that way, because what's happened to the value of the U.S. dollar over time?
It goes down
significantly. Where were you 30 years ago?
Where was I 30 years ago? I was in Germany. About to come 2 years later, I came to the U.S. So I still was in Germany.
Still was in Germany. So do you remember what the price of things were when you first got to the United States?
Yes. Like gas was $1.80, something like that. And everything was like much cheaper. Yeah, you got like 99-cent burgers and 99 cents Whoppers were all over the place. And now they're like $5.
Oh yeah! In fact, you go backwards.
Burgers, but yeah,
now, I walked
burgers, but not McDonald's and Burger King burgers.
Yeah, that we're talking about real burgers, not the plastic burgers. Where I look back on this, I remember walking to my very first Taco Bell 30 years ago, in 1994.
29 cents tacos.
Well, you could get 2 crunchy tacos, 2 bean burritos, and a drink for $1.99.
Yeah, on
their value menu. Do you know what that is right now?
I don't.
It'll cost you with tax just shy of $14.
Holy cow!
That's nearly an 800% increase in the Taco Bell index over 30 years. Wow. So if the dollar spends that way, it's not that tacos got bigger, right? They're not that much bigger. I stop there and get stuff for my kids. I don't eat that crap anymore. And some scientists didn't discover that Taco Bell is a superfood, so they didn't justify their price that way. It's because the dollar we're buying tacos with is worth that much less. You know, the other thing here, and I bring this as an illustration. So I've got and I'll hand this to you. What is this?
That looks like a gold coin.
And what is it?
Disappearing.
You can imagine.
This is let me read it. United States of America, $20.
$20, right?
So
that's a 1 ounce 1888 gold Liberty that was minted for $20. Is it really worth this?
No, that thing is worth, it's a 1 ounce, it's worth what, 3,300, 3,800, 3,300?
About $3,800 right now.
Yeah,
and because
like
it's minted in 1888, it's worth closer to $6,000 or $7,000.
Probably, yes.
Right?
It's a collector's
so
item.
Why is that minted for stamped for $20 and this is stamped for $20? Back in the early 1920s and before, you could go into a department store, get a hand-tailored suit, a hat, a shirt, a tie, a belt, a pair of socks, and a pair of shoes for that $20. I can't buy these socks with these $20. Yeah. Why? Why is it so different?
Because the dollar has gone down in value.
Unfortunately, the dollar has declined that much in value. Yes, you do have to give that back because the dollar has declined that much in value.
Right.
You know what is interesting about that is I can still walk into a department store and get a hand-tailored suit, a hat, a shirt, a tie, a belt, a pair of socks, a pair of shoes with this $20 because it's gold. Mm-hmm. The clothing has not become more expensive. The gold has not become more valuable. This has become worth that much less. So when you recalculate the value of the dollar, when you factor in the gold index basically or the Taco Bell index against your mortgage, and you recalculate the value every time you make a payment to the lender, every single month for 360 months, you're not paying them $402,000. The value of those dollars is equivalent to $154,000. You gave them back less than what you borrowed. So when people pay their mortgage off early, the banks make more money because the dollar is worth more at that time.
So you're basically saying like you're paying them $400-something thousand, but if you take into consideration inflation, that is in your calculation a little bit higher than even the interest rate you pay for the loan. In real money, you're basically paying less back than you actually borrowed.
Yep, the value of the return is less than what you borrowed.
It would be stupid to pay this thing off early because the longer you can drag it out, the basically at that fixed interest rate, the in real terms less money you actually pay them.
Correct. The less you make, the less you pay. Why do you think it's being perpetuated? Pay it off early. It's not. We think that this is some sort of miraculous thought process somebody created, and they're trying to mill it out. I was not sitting in the room when it was done. I don't know that there was this background thing, but I can guarantee the banking industry or the banking people call it the banking cartel. That's what they want you to do is pay them off faster while the dollar is worth more. They can put it to work more and continue to keep moving that dollar. The other thing is
the fees.
And the fees, right? Yeah. Pay it off early, but then inevitably you need to pull cash back out. If you look at the refinances, I encourage people, if you don't pull money out to reinvest, do not refinance. Refinancing for rate is a fool's errand. Now, I get if you have an 8% rate and the rates go down to 2%. Why would you not? I would love to have a 2% on everything because I could put that on my headstone. Died with 2% on all his mortgages, right? That's at least just a feather in your cap. But when you're talking about refinancing just for the rates going down to 1% or something like that, that to me is a foolish move. Because when you start looking at what's happening, you're resetting yourself. Look at you've looked at a 30-year fixed amortization table, right?
Yes.
What does the first 5 years look like?
Mostly interest.
It's almost all interest, right?
Almost all interest, yeah.
Now,
I mean, we use that when we sell land. We sell land, we sell financing. And I love the land loans. The longer you drag them out, if it's like the 3-year land loans, they're like the amortization is like this. If I can sell somebody a piece of land with an 18-year amortization, it looks like this. It says, and I'm the beneficiary because the first 5-6 years, it's almost all interest, and they end up paying way more interest than they're actually paying in principal to us. And our loans are not 5% loans. They're 14, 15% loans. So that actually makes even more sense for us.
Yeah, and exactly. So you get where they're coming from, why they would structure the amortization table that way. And then when you look in history, how often the average person refinanced their mortgage on their primary residence, it's like every 4 to 6 years, so every 5 years. Well, think about that. So I've got an example. I had a client come to me. He was using a specific mortgage guy for years. That guy retired, so he ended up, my client, he had bought a home for $120,000. He'd been paying on it for 47 months. He came to me just before he made his 48th payment. I'm like, well, how much cash out would you like? Well, none. I'm just refinancing because the rates went down. I couldn't talk him out of it. I even showed him the numbers. After 48 payments, he made his 48th payment while he was working with me on that loan. He had paid just shy of $38,000 in payments. That's how many checks how much he paid in checks to pay that mortgage. But the balance had only gone down by about $6,000. Mm-hmm. $38,000 paid out, $6,000 actually affected his balance. So then we got the refinance done. He has costs about $5,800, $5,900. Where do you think he put those costs?
In the loan.
He added them onto the loan. His new balance was within $102 of the original balance 48 months before, but he paid $32,000 to the banking industry and started that over again.
Right.
They keep you in servitude, financial servitude, refinance your rates when the rates go down, pay extra on your mortgage, all those things. Why? So they can control you.
But isn't there a break even at some point of time because now his payments is lower? And so he's saving a little bit.
Not if you continue to follow the same practice.
That's right. If he continues doing it again and again, but if he now sticks to it and just pays
if he sticks to it, yes, but he's still
like
out.
4, 6, 7 years later or something like that, there's a point where the difference in the payment makes up what he kind of lost before.
Doubtful, because you still have that heavy interest only that he paid out, or heavily mostly interest. It'd probably be something you have to write. If you rode that out to the end of the 30 years, there may be an offset, but I doubt that it's enough.
Okay.
The other thing is when you consider if you just stayed in it without getting that little bit lower payment, you still get to deduct it from your taxes, right?
Right.
Now he has a lower deduction.
True.
Now, I also know with the way the tax codes are written, all that stuff, you have to adjust things properly. You have to set things up properly. We work with a lot of real estate investors to help them set it up properly. I've got a law firm that I work with. It's a national law firm. We've got a package deal for people. You come to us as a real estate investor. You want to get started, we'll connect you with these guys who have a package deal to get you your family trust set up, get your Wyoming Holding Corporation, then the LLCs in the different places where you're going to buy investment real estate. Using the DSCR loan, you put 20% down. Now you have a company that owns it. You now have the properly set up for your taxes. They have a sister company that handles your taxes, and they talk to your lender. Everybody is making sure that you're becoming successful instead of being caught between a whole bunch of different groups, potentially getting set up incorrectly. So we're taking a very, very heavy interest in making sure the real estate investor is acquiring properly, setting themselves up properly, being bankable, and continue to compound that, and then have something they can hand off to the next generation. Because I don't believe that our next couple of generations are going to have a shot in hell at owning and having these things established for themselves if we don't start now.
Now, bringing it back to the example you brought up. So what's the total return that in this scenario, the landlord, the owner of the house, would actually make?
In that particular scenario, when I run that with the $100 compounding cash flow, we were approaching 32 to 35% return on investment per year, not including your tax benefits.
Not including tax benefits. Listen to that. That's really the key here. So between what you paid off, it's $5,000 a month if you stick it out all the way to the end. Between the appreciation, $5,000 a month, or roughly speaking, $5,000
a year.
A year, I'm sorry, not a month. Yes, a year. $5,000 a year in payoff, in an equity gain by basically paying the loan down. On average, $5,000 a year in gain, in market value appreciation. And on top of it, the rents that keep going up, that can make out of a deal that looks like crap at the beginning. Mm-hmm. A $200,000 property, you put 40 grand plus closing costs, say 50 grand, and you have $100 cash flow. Eventually, that makes it a 32 to 38% per year return. That is pretty cool. Now, the downside of that is it takes a long time until that becomes cash flow, because people want to invest. There's this myth out there, which I want to call it a myth, that rental properties, you can retire from rental properties from their cash flow. What's your opinion about that?
Oh, I preach that all the dang time. Is like, don't expect this to be a retirement plan for right away. I get people that are like 26 years old and I want to be retired by 35. I'm like, this is not the path. You want to be retired by 35, you got to invent some sort of crazy thing that people buy like crazy and retire you that way. I'm of the mindset that if you have a ton of capital to keep expanding it and compounding it, yeah, you might be able to pull that off. I treat that as like a business. Set up your holding company, your Wyoming holding company, buy your properties utilizing your LLCs, get your DSCR loans, and then take all that capital instead of looking at it as cash flow or cash on cash return, any of that stuff. That to me is reserved capital that goes into that account. Just keep building that account. Don't take cash flow. Now, eventually, you might get to a point after a few years that there's a surplus that you can start taking those distributions or put yourself on a salary for managing it or something to that effect. But don't think. I don't look at that as a retirement plan whatsoever. To me, that's a new business.
Because there's always things that happen. Also, like you need to build up reserves for that because there's stuff that happens. A boiler breaks, a refrigerator breaks, the roof has damages, whatever it might be. There's like I sold them all now. I used to own 17 houses in Cleveland or outside of Cleveland, Ohio, and they were all 100 years old, 80 to 100 years old. Well, we paid them cash. We paid we bought them for about $50,000 to $70,000 a piece and put like 10 grand in. So on average, they were about 70 grand into those. They all rented for about $1,000 a month. What was my cash flow on these properties?
Yeah.
Zero.
Because you're
cash flow is
keeping
zero because
it up.
every freaking month, one of these things had a $10,000 damage to them, like a foundation issue, something like a water main break in the basement, the basement water break, air condition, an $8,000 like heating, something like that breaking, and at the end of the day, though, after owning them for 5 years, we had 17 fully remodeled houses because they all had brand new things.
Well, you got to remodel it over time, right? As the things break, it's not like you're dumping a ton of capital up front. And that's what I tell a lot of folks. If you're really caught up in cash flow, and that's what you're going to focus on, so what's going to give me the best cash on cash return, you're going to have to buy some, and forgive it, guys, some St. Louis shitbox that's going to give you this proposed cash flow that you're going to need to hang on to fix it every time it breaks, because those particular properties will always have that problem. Now, if you
that's what we realized. We bought them for cash flow, because we're land investors, so it was one of our earlier purchases. We taken the land from the money we made from land investing and started buying these houses, thinking, well, it's great, another cash flow source. And there wasn't any cash flow source. On the good side, though, they all doubled and tripled in value over those 5 to 10 years that we held them. So we were able to sell them with a profit. So it's all good, but it wasn't cash flow, and that's the thing. A lot of the people that buy rental houses, they are thinking that 5 years later they can retire of that. And those $500 cash flow that you make per house very quickly goes to zero when the tenant moves out or when any kind of repairs come up. And I just want to make sure people, you agree with that, right?
Oh, yeah, most definitely. We always talk about that. If you're going to find a cash flowing house today, it's because it's one of those type of areas that's going to treat it that way. And you're going to need every cent of cash flow to maintain that home. It will still be a great deal. You'll still get the appreciation. You'll still get be able to raise rents over time. You'll still be able to get all these things, the amortization on the loan. But if you paid for cash, you're not getting the amortization on the loan. That's the other thing I tell a lot of folks. They'll come to me like, well, I'll just pay cash if I get better cash flow. You actually don't get better cash flow by paying cash. If you had $100,000 and you invested it into a home that was renting for $1,000 a month, you might be making about $700 a month in cash flow after taxes and insurance. But if you took that same $100,000, distributed over 4 houses at $25,000 down, because they're $100,000 homes, right? Because you have 20% down plus your $5,000 in change for costs, because you're still going to have costs on your $100,000 purchase that's cash. You'll have an equivalent amount of money go out, right? $100,000 invested. But but you've got one home appreciating at 2.5%. Let's say they're all 2.5%. So your single house you pay cash for 2.5% appreciation. Well, that's only 2.5% on your $100,000. But if you got 4 houses appreciating at 2.5%, on the 80% loan to value loans, now you're getting 10%. Now you got a 40% growth on your same 100,000, which is better. 2.5% on 100,000 because you paid cash, or 40% because you've got 10% on each one when you start getting the fact you only have 20% down plus costs. Then you start getting into the amortization of the loan. You don't have it when you're putting 100%, when you're buying it 100%, I want to say 100% down, but you're paying cash for the house. Versus 20% down on 4 houses. Now you're getting the amortization of those loans at another 10.6%, right? So now you're making so now you're at the 20.6%. Where over here, you're still only at 2.5%. Right. So when people start to understand by leveraging is actually where most of the wealth is created, when that light turns on, man, they just jump into it. But now it's a matter of finding the right asset. It's a business. Do you buy one that's proposed to cash flow really well because it's cheap? It's like buying a Circle K franchise. Right, you get it on the most distant rural corner there is because it's cheap, or you get the busiest corner you can possibly find that's going to have the most traffic, but it's the most expensive. You get the one that's the most expensive. That's going to have the better chance at having being a better business than the really cheap one that's very, very rural. Yeah. Right, you have to look at the exact same when it comes to your housing.
Yeah, I agree that. Great. Well, there we go. So that's a waterfall of information right there. So let's move on to a different subject matter right now. What do you think interest rates are doing right now? What's going to happen? Where are we? What are you doing?
So we're gonna rabbit hole some stuff because I should have brought my tin foil steel hat because I have one that I wrapped in foil because I like to put that on and talk about. So we're talking about interest rates. People think that the Fed. There's a lot of people sitting there just can't wait to see what the Fed going to do because the Fed's going to. We have the actual rates decision being issued tomorrow, the 17th of September.
Now we're recording this on September 16th, and on the 17th the Fed meets. Everyone expects a quarter drop, but some people say half a point, but probably a quarter.
Well, exactly 1 year ago they dropped a half, right? And that was a big deal. They dropped half. What happened to the interest rates the day after, or 2 days after they dropped it?
They actually went up. I think
they went up a lot, right? Then they dropped them again in October. I think it was. was it October or November? What happened again?
Now, why is that? Now, why is that? Why do interest rates not drop when the Fed drops the rates?
So where does the money come for mortgages?
You tell me. From
So
banks.
it comes from mortgage-backed securities.
Yes.
So everybody tracks the Treasury, the 10-year Treasury. Does the 10-year Treasury fund loans for people to buy houses?
No, but that's what the lenders are somehow rent themselves.
A lot of people track it because that's a long-term bond. There used to be a 30-year Treasury that used to be tracked back pre-crash. Then it converted to be the 10-year that everybody's focusing on. So the supply and demand of money all comes from a long-term instrument, which would be a bond. So you have the mortgage-backed security, which is a bond. Did you ever see the movie The Big Short?
Yes.
Okay, so there's a guy talked about in the very beginning by the name of Lou Ranieri, right? And he showed this power. It was a overhead projector, right? All these houses. And he drew this circle around. They wrapped them all up into this security called a mortgage-backed security. And he said the famous line of theirs: "Who the hell doesn't pay their mortgage?" Well, we found out who the hell doesn't pay their mortgage in 2008 when people were given mortgages that shouldn't have been given mortgages. We had this push for people to get houses. Everybody deserves a home, this whole deserve situation. So then they created these loans to give people houses with zero down, and you can make up your income. Just had to be somewhat reasonable. Well, we know what happens when you give people a little bit of latitude. They make up a lot of things. Then you have the realtors out there saying, hey, I know they qualify for this. You said $250,000, but they really love this $300,000 house. Could you make that work? And because they get a bigger commission, the client's happier, they get their dream. So they're getting these houses they can't afford. Then they put in these loans that give this interest-only period up front so they can afford it until they can't afford it any longer. Then you get to the crash of 2008 where people couldn't afford their houses. They go into foreclosure and into short sales, and the market completely crashes and affects us globally. Then you've got houses being bought up like mad by investors and hedge funds at their cheapest point. The house we sit in here, your home, probably was selling for just a little over $200,000 back then, when things were at their absolute lowest. Well, you get all this massive buy-up of these homes, and then they started what's called...
Well, that's when we started buying. Not this house. I think this house was a little higher. But that's when we started buying houses, 2009. I went to a RIA, to a Real Estate Investor Association meeting, and I was sitting there, and there's like, because we had blinders on, land only, and we didn't participate in any of that. And all of a sudden, it's like, you can buy houses in Phoenix for $50,000.
Yeah,
and they used to cost $250,000 just a year and a half earlier. And that's when we started just pouring money in and buying these houses, and most of them we still have, and they're worth $400,000 a house, and we still have them.
See, and that's awesome. That's what I wished I was in that position. I'll share why I wasn't in that position at the time. We'll get into that, I'm sure, in this conversation. But ultimately, then you get to the point where they started the bailout, and then the Fed decided. You got the Hank Paulson, who was the Secretary of the Treasury, and then you got Ben Bernanke, who was the Chairman of the Fed, gets together and they create the bailout, and they start giving money to the banks. Now, the banks were also heavily invested in by the hedge funds who bought all the dang houses. So we take public capital, create money out of thin air, shove it out and give it to banks and give it to hedge funds, and then we invest over $8 trillion into the market. So that goes into the mortgage-backed security that was created by Lou Ranieri. So the Fed goes and dumps money in there, and the day they announced it, which was November 25th of 2008, if I remember correctly, they announced quantitative easing, saying we as the Federal Reserve will start buying money into the markets and putting capital in there to help ease the economy and spur things. By dumping that money in there, they made more money available. And what happens with supply and demand? When there's a higher supply, what's the value, right?
Yeah.
So if you and I went into an auction and we're going to buy a Panerai watch, there's one Panerai available at all. Nobody will sell other Panerais except for there's one available at this auction. We walked in there with 500 people that wanted that one watch. How expensive is that watch?
That watch is going to go to the roof. Yeah.
Through the freaking roof. But if we walked in, there's only me and you. It's like we want a Panerai, but there's 500 Panerais to choose, and they're all the exact same one. How cheap is that Panerai that day?
They're going to be dirt cheap.
Yeah, exactly. You might as well get the little digital Seiko, right? So that's basically what happened. They made a lot available, but not a lot of people could borrow during that window of time. So the rates went really, really, really low. But the people who could buy, they started bidding things up, bidding it up like crazy. And you got that window of time from 2009, January 1, 2009, when they actually started putting money into the market, all the way up until 2021, where they invested all that capital and drove the rates way down.
And not only that, they also, by the Fed buying all these bad assets and eventually writing them off, they're just flood the market with liquidity, not only for that, but it's like it's basically an indirect way of printing money too, and just overall flooding more money into the market and
devaluing the dollar. But then pushing the prices up.
Yeah.
So what did that do for the hedge funds' holdings when they bought up all kinds of houses during the crash, and all these people bought houses during the crash when it was worth less, but now you're driving the prices up for people who held that asset.
Oh, they look good.
Now everything looks good on a balance sheet. It looks phenomenal on a balance sheet. And then they cut it off in 2021. The end of October 2021, they cut that off. And when they did the quantitative tightening, they stopped reinvesting capital into the markets. And then what happened to the interest rates? They went through the roof, right? And then what happens is if you watch the charts, and I wished I had them here, but I've been following this since the early 2000s. I've been following the mortgage-backed securities. You have to pay quite a bit. I pay about $1,000 a year to be able to watch those trade. Everybody watches the Treasury trade because it's a long-term bond, just like the MBS is. But you can just watch the long-term bond as far as the Treasury for free. You have to pay to see the UMBS trade itself, the mortgage-backed security. So I pay to watch that. Now when we approach the point, or at least the level of the value of the security at the point where they announce quantitative easing, we hit that and we bounce off all the time, because that was the value of the security before the Fed started injecting capital into it. But after the Fed started injecting capital into it, it's like you and me sitting out for lunch. Let's say we're grabbing dinner at Ruth's Chris, and there's three guys that walk in 3-piece suits sitting next to us, and they start talking about putting $200 million into a particular stock. What are you and I doing on our Robinhood accounts while they're talking?
Buying that stock.
We're dumping money into that stock, right? All the Fed did in November of 2008 is tell the world, we're going to dump tons of money over here. And they're like, yes, they start putting money in. Well, if you look at the open of that day, November of 2008, the day they announced it, to the end of that day, it traded significantly. Mm-hmm. Now, when I draw my charts all the way across, I can see that every time it hits that the same value of the security the day they announced it, it bounced off of it. But it's every other time. Every other time it approaches that, either it goes through it to the top of that day's value or it hits the bottom of that day's value. It keeps bouncing there. We're in that window right now. And so the last time, that means we're at the peak of the value of the security. Therefore, nobody's going to put more money in to bring the rates down than where it is right now, because it's not worth that unless they have additional capital being put in by somebody who doesn't care about the value of the security, which would be a government or our own Treasury putting the money in. So the private sector is not willing, in my opinion, to invest any more money into the MBS than what they are at today's value. Therefore, they bid it up to a certain point and then they sell off and get out of it. So the last time the Fed lowered rates, or a year ago, is in September 2024, we're within 12 basis points of the value of the security the day that they announced their dropping of the rate by 0.25%, by 0.5%.
So in other words, what you're saying is, let me just try to gather that. What you're saying is like that the private sector is not willing to buy more of that, and the more they buy, the more competition there is. In that case, actually, the more money they throw at it, actually, the lower the rates would be.
The lower the rates would be.
That's a little counterintuitive initially, because if you have a bunch of money, in this case, chasing somebody who has has the money, then or has a mortgage-backed security, then they're paying more for the mortgage-backed security, but it means the yield gets lower. So in interest, they're willing to take a lower interest rate.
Yep, they're correct.
And so therefore,
price goes up,
but
return goes down.
Return goes down. So the same with the treasuries. Same thing. When China and everyone in the world wants to buy all our securities, then interest rates, then the government can say, well, we don't have to give you 7%. We can give you 2%, and you're still going to buy it.
Yeah, because everybody else wants it.
Because
if you don't take it, somebody else will take it.
Right. So it's like so. In this case, what you're saying right now is that there's a limited appetite for that, and as a result, no matter what the Fed does, the rates are not budging.
The rates will not budge. In fact, they might go up if the Fed drops it too much.
Okay. Now, how about all this overall federal deficit that seems to be going on even more with the big beautiful bill and things like that?
We're talking about $37 trillion in debt. Like here's what you're talking about?
Yeah, like all these, the 37 trillion in debt that we already are, plus what seems to be like $2 trillion a year. We're going into more debt because no matter who is president, they're not balancing the budget. They're just finding more ways to spend more.
Honestly, I believe it's impossible to balance a budget at this point. I don't know how you can balance a budget without cutting an enormous amount. We have an overly,
but we have a very, very
top-heavy government.
Would that not affect, how does that affect the rates? Is that part of the reason why they're not going down? Because basically, partly the world is losing trust in the dollar, perhaps?
Well, it really boils down to is why would you want to invest more money into a place where you're getting less return on investment? So right now, when you think about the interest rates being in the mid to low sixes for a person buying a house to live in on a 30-year fixed conventional loan, by the time they're done with all the servicing and all the middleman stuff that has to happen to collect that payment, whoever is lending that money out is probably making 4.5% on their investment. You're not getting anywhere near to keep up with inflation whatsoever. So it's a matter of just paper trading and trying to move that in and out of it and trying to offset some other things. And when it comes to the market, it's really an emotional place. It's really, anytime you're watching trades, it's all traded based upon emotion or belief of what's going to happen with the news that comes out the next day. Money keeps moving as a result of that. I think when they lower the interest rates, it's an inflationary move. Therefore, because costs are going to go down on a short-term basis when you're talking about interest rates going down, therefore it might spur economic movement. Therefore, money might come out of the mortgage-backed securities and push over to stocks. Or push over to something else that would be to create a better return. Therefore, we'd see interest rates go up because money is leaving the mortgage-backed securities and going to other places in the economy that would possibly give a better return. Now, if we're seeing weakness in the market, they're going to raise interest rates because the Fed's going to raise it because we're in a much weaker market. So, or actually, no, not weakness in the market. We're seeing too much happening. It's too inflationary. Then they might end up having to push money over. That money might move that and go into bonds because we're going to see things as far as difficulty in the equities. You got companies that are losing money.
It makes sense. But if we hit like a bigger recession, let's say right now, because of the tariffs and things, and I mean, some people say that tariffs is great because they brought in a whole bunch of money, and I'm not against the tariffs. I think actually, the way I look at the tariffs, with some exceptions, is that the world has indeed charged us, like Japan. We as a family went to Japan like 5-6 years ago, like just before COVID. And you can barely see a Western car in Japan. Mm-hmm. Like you come to the US, Toyota is everywhere, right? So you go to Europe, you can barely see an American car in Europe. And it's
you can't even fit an American car in Europe. I mean, the size. Can you see a Ford F-250 rolling around out there?
That's true. But actually, they're selling them now. But they're even the small ones. There's a whole bunch of small American cars now. Mm-hmm. You don't find them, and it's not because American companies don't want to sell their cars in Europe. It's because Europe traditionally had entry barriers for American cars and had entry barriers for Japanese cars. So Europe, you see mostly European cars. Germany, you see mostly German cars. And in Japan, you see mostly Japanese cars. Only in the US, we let everyone in without any kind of tariffs. So it's kind of like, hey, you lower yours or we bring ours up. I'm not necessarily against that from a just fairness point of view, because it is kind of true that everyone gets to do whatever they want here. And in other countries, they had put up barriers and now they're just yelling, they're screaming so unfair, when in reality for decades they had done the exact same thing. So I'm not against that, generally speaking, but from a fiscally point of view, it increases prices. It potentially creates a recession. It creates even more inflation and things like that. What do you see that in that environment? You see, what if that hits? What if because of many of these factors overall we hit a big recession? Wouldn't the government just open the floodgates again?
You would think, but it's kind of hard to say because everything that we're experiencing right now, we're in uncharted territory as far as I can tell. When you talk about coming off of a however many years of quantitative easing and then of course an unbelievable deficit and an unbelievable debt that we have as a nation, we don't have a history of what's going to happen. No. We don't have anything to look back on. So everything that we offer would be pure speculation because we don't know how the market's going to react. And everything that happens as far as interest rates, stocks, precious metals, commodities, anything along those lines happens because of emotional response to what's happening in the news and in the market. And people are going to run wherever they feel that they're going to have the best return, and they're going to be they believe that they will be the safest. So it's kind of hard to even make that call. All I truly believe, just by looking at the charts and the price action of history and what's going on in the markets, I believe we've seen the peak of what our interest rates would be as far as their low points, and that we're going to be trading in this same range as far as rates will be or should be. I mean, they could go down significantly. I don't know how. They'd have to pull money from somewhere, an enormous amount of money from somewhere, get the rates go down further than they are today. But I believe that we keep seeing where we're at today as probably our best interest rates, if not by just about another maybe 1/4 or 0.5%. I don't see us getting any better than that anytime soon, unless it's going to be affected by a significant amount of capital in the form of quantitative easing. Now, is it possible to have that again? I think so. You've got hedge funds that are more, and banks. Like was it Chase, the biggest banking entity in the world? They have a lot of influence. And there's an enormous amount of influence on our politicians and those who are making decisions on policy from the capitalistic side of it when you're talking about these large hedge funds and these large banking entities. And if they see that it benefits them to push interest rates lower, they can influence that printing of capital. When you look back on who did that, these guys all came from Wall Street. All of that is going to influence that. We could see those interest rates go down. If they do, take advantage of it for the moment, but the unintended consequences or possibly intended consequences by the people who are forcing that to happen, I think it'll be very, very destructive for our economy to keep trying to get those rates to go down.
What do you advise your people that come to you right now? Obviously, you have an incentive to sell them a new mortgage, but you also have obviously demonstrated that more important is that you want them to be successful. So sometimes if it does make sense, you try to talk them out of it. But in this environment right now, if somebody comes to you with do you think it's a good time to buy real estate for long-term hold? Do you think it's a bad time? Do you think it's a good time to refinance? It's a bad time? What is your take on that right now?
I think it's an amazing time to purchase. I think everybody should be buying real estate and holding on to it because right now, some people are worried that it's going to go down. We're going to see this major crash in real estate, but we don't have the problem that we had in 2008. 2008, they were overbuilding and underbuying. So what did they have to do? They had to stimulate it somehow, and they stimulated it by giving you these practically free loans with making up your income. We don't have that happening right now. So since that's not the case, we don't have the inventory. Every time you're seeing construction, most of the construction we're seeing is apartments, right? We're becoming a subscription-based economy. My opinion, again, this is just Aaron Chapman's opinion, when you start looking at the holdings of hedge funds, you start looking at the history of all this, put your tinfoil hat on, go all the way back pre-2008, in the 90s when they were doing all these things and building this up. My belief is the most valuable per square foot real estate is the single family house. Why would hedge funds own so stinking many of them if they weren't going to be the most valuable asset out there? And they don't plan on, they're trying to get as much of their vertical housing as they possibly can because they can keep raising the rents on those because they're not building enough single family housing. So it's going to have the shortage where there's going to always be a demand, be forcing people to have to pay whatever's offered to them. I'm of the mindset families need to come together. They need to work together to buy assets together. That's what we're doing in my family is we have the family trust. Everybody lives in houses owned by entities that are within the trust. I pay rent to my trust ultimately through the entities that we have. I own nothing. It's all owned within all that structure. And even my cars are within LLCs that are owned by the trust ultimately. And I lease those. I don't own anything. And so we come together as a family to have houses that everybody lives in that pays to the trust plus an additional extra $200 a month per house that goes into the middle. So if an AC breaks, we've got $30-some thousand sitting there to pull from it. If we achieve $50,000 in that account, we shut off that $200 a month to everybody. Unless we pull from it again, then we pump that back up. We have to come together as a group to be able to be successful in this particular environment. And I think everybody needs to do that. So I'm training and coaching and helping my clients to do the same. If they want to, they don't have to. But I want to give them the best information I can to ensure their success to the best of my ability. Do I know what's going to happen tomorrow? Are they going to outlaw certain things? Are they going to change some stuff? There's some dirtbag shit going on when it comes to municipalities, when it comes to government in general, when it comes to the banking industry. They can change it tomorrow, but we're trying to do the best we can with the information we have. That's the benefit that I have of being in the industry I've been in since 1997. And I wish I was in a position in 2008 to have taken advantage of the economy the way that you and your family did. But in August 8th of 2008, I was heading out of town on a Harley trying to get my head clear. And 15 minutes into that ride on the 101 and the 202 exit there, I was taken out by a kid in his dad's truck. And I went skidding down the freeway at 80 miles an hour and was left lane at the Rio Salado exit with 2 shattered legs, a bunch of broken ribs, and an impact to my head that left me with a lot of memory loss. So Weeks later, when I came out of the hospital, I went into that hospital with a net worth just under $4 million. I was 190 pounds, 6'1". I rolled out of there at 156 pounds in a wheelchair with a memory that would recycle every 3 minutes, and I had a negative net worth of 1.5 million. I had to start over with a 460 credit score and rebuild everything. And by 2016, by the grace of God, was I allowed to not only get all my faculties back, get my memory back to where to start working again. I was able to get my credit score up into the 700s, was able to get everybody settled with. I got 90 grand set aside so I can start buying investment real estate again. I started my infinite banking policy and started from there. So now it's 7 policies later, multiple different, I have houses in 6 different states. All the family has houses they live in that's associated with the trust that we built. My business is still in existence and still working and still growing. And I've got a book coming out here soon. I've got relationships all over the planet.
We'll have you back for the book.
Yep, and I'm looking forward to your feedback on that one. And I honestly believe this is going to be you're going to love it or you're going to hate it. I don't believe there's any middle ground on this thing. But I invested everything I could into it, a significant amount. I partnered with Robert Allen as far as kind of coaching me on how to write it, because I've written things before and I did everything wrong. So he's like, you got to write another book. So I wrote another one. He said, you need to illustrate this book. So then we engaged my little brother, younger brother, and he's an artist, and he did all the artwork on it. And Dolph DeRoos wrote the afterword, and I've got a lot of contributions to this thing. And by the time it's all said and done, I'll have over $100,000 in that work.
Wow. And we'll have you and your brother back for that just before the release. So stay tuned if you enjoyed that. I have one last question, and that is, perhaps we go 5 minutes more, and that is, with all the advances and the roaring in of AI and the potential job loss for millions of that, or perhaps not. Some people say we're at the beginning of abundance, that everyone is gonna, all the boring stuff is going to be taken care of by AI, and we all going to be busy creating beautiful things in our lives, and then we're going to live in utopia. And some other people say, like, no, the machines are going to take over and we're going to be in dystopia. And probably some of it is true on both ends, but bottom line is but there's a potential for a lot of people losing their jobs at the same time, for a lot of people and I'm going more down the direction that I think we're going to eventually be on a plan where a lot of people are going to be on Unified Business Basic Income, UBI. If that happens, have you been thinking about these kind of things? Or if that happens, what do you think, financially speaking, is the reaction to this world? There's a potential that all house prices go down because nobody can afford the nice houses anymore. Mm-hmm. You were thinking about those kind of risks, or? Oh,
believe me, there's a lot of stuff that keeps me awake when it comes to the AI thought process, and it's kind of hard to say how that's all going to go down. It's impossible to not think Terminator, right?
Right.
It's like, who doesn't think that way? It's like, okay, we need to get plenty. We get a lot of precious metals. My favorite precious metal is copper jacketed lead. Lots of it, right? Because if we're going to have the Terminator thing, you're going to need that. But it's really hard to say. I don't know that we have a whole heck of a lot of time because of the exponential growth and exponential exactly what's happening with AI. It's taking such big leaps overnight that I don't see how we can't have some sort of social problem that comes as a result of that. Does it achieve a point where it takes over? Potentially. Is it possible to unplug it? Probably not. And I also believe that there's people in the background manipulating whatever is there to ensure that we do have people put into some sort of slavery, servitude, however you want to put that. The best advice I can give any single person whatsoever is start being really, 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 really good with your prayers. Start building up that relationship with Christ and with God, and really becoming a different person. Start seeking the spiritual a lot more often. I believe that things have started to go into a way that we can't discern what's right and wrong anymore. It's becoming so muddied. When you start seeing the way that AI has, and the way that people have started to see that it's impossible to really tell what's reality. They have manipulated things so well that we as a human can't figure that out for ourselves. We have to be, in my opinion, be closer to more of a godly people than ever needed to before in history. And that's what I'm doing. That's what I think a person needs to do. Start looking at things that way.
Beautiful. I agree with that. I mean, especially with like the shooting of Charlie Kirk and things and those kind of things. That seems to have really massively polarized and activated the a big part of the moderate conservatives to really be like, no more. I've had this. And at the same time, it has polarized the country even more. Because like I'm kind of like, my algorithm shows me surprisingly both sides, because I sometimes can understand the left side and what they're thinking about, and I can relate to some of these things, and I relate definitely to the conservative sides. I'm definitely leaning more towards that, and the stuff that I'm seeing is like they're not even in the same realities. And I'm not saying which reality is the right one, but it's just simply like these are two completely different realities, and there's no more overlap. And the only person, in my opinion, that was actually trying to make that overlap happen, they just shot.
As a result of all those twists and all that stuff, I tell everybody, you got to really, really start getting closer to God to understand what you're seeing. But one of the things I found interesting as I'm watching what happened with Charlie, it goes back to the story of Saul when then become Paul, right? You had that. He was there to stir up all these things against everybody, and he was one of those ones who was on one opposite side of it. Then you have the prophet killed, and then he flipped, and he became somebody who was a very, very influential for God. Is that possible? That might be that we may be seeing that return in history. I don't know. It's a possibility that we may have somebody who is on that opposite side who saw this, and witnesses might be able to rise up and help people to see that we're witnessing something that you need to have a different opinion of and bring us together closer. I hope so. I hope that this big division starts to bring people together quicker, but I don't know that's going to be the pace. We're going to have big division, but then we're going to have a lot of people that come together, and I think that it's going to be potentially a beautiful thing. That people come together. I hope that it is. I really
pray for that and hope for that.
Yeah, I think that there's a lot of opportunity for us to collect a lot more people, right? Have a lot more relationships, a lot more experiences, and really get what's valuable in this life. And it's really not about the money. It's about the people we are able to interact with because of the resources we have.
Beautiful. And in the meantime, you're perfectly positioned to ride out any kind of storm because you're a massive hunter. You're an outdoors guy. You're like, I remember last time I saw you, I carried a gun, like a gun case through the airport for you. People thought, because the way I look, thought it was a piano. But
you had your keyboard.
It's my keyboard.
Jack Bosch with his keyboard.
There. And
you're carrying. I had. What did I have with me on that? Because I was driving back to Missouri. I had an AR in there and a shotgun.
So we were on the same flight, and so going to a same meeting, a couple of mastermind meeting with a bunch of real estate investors and educators. And so since we know each other, we took an Uber together, and he needed to pick up some luggage, and it turns out that it's a whole bunch of rifles and things that he was bringing to his spare home that he has somewhere out there. So that was fun. That was fun driving it around, riding around.
That's very interesting always.
Well, I think you brought it to a beautiful end. Let's wrap it up right here. Is there anything, how can people get a hold of you if they need your services, if they want to be learning about how to structure this with the trusts and all the different things? And how does somebody get in touch with you?
Just go to aaronchapman.com. That's going to be the easiest way to get a hold of us there. You can also email me at info@aaronchapman.com. That's being monitored all the time, and that will always be there. Those will always be the URL and the email address to get a hold of me.
All right, wonderful. So with that said, that's a wrap. Thank you very much. As always, go share this episode. Think about rates. Think about the economy. Think about what's happening. Become a critical thinker, and really analyze what's happening in this world. You'll be a better person for it. That's it. Thank you very much. Bye-bye.